What's going on, guys? In this video, we're going to be talking about the poor man's covered call. I'm going to be showing you some examples. I'm going to be talking about how this strategy can be used to make a lot of money for you consistently. You guys can see my screen right now. The portfolio hit $2.5 million. So we're over $2.5 million. Pretty decent month at 2.44%. I do like to aim for 4%, but the poor man's covered call strategy can blow these numbers out of the water. I just have a bigger portfolio. That's why it's dragged down because of my larger account strategies. But the poor man's covered call can make 5, 10, or 15% per month, especially if you pick a stock that's bullish, whether that's NVIDIA or any other technology stock right now, Meta, Google, Amazon, Apple. Apple has been one of my top stocks, and it's been going absolutely parabolic. You can actually see right here, I have Apple and I have $222,000 gained on Apple. But I'm going to be showing you a poor man's covered call example on Apple right now. So specifically, the poor man's covered call strategy is one of the best if you don't have that much money to work with. Now, you can also use the poor man's covered call strategy even if you have a 50K portfolio, 100K portfolio, a 10K portfolio. This is a very versatile strategy, which is why I love it so much. I think it's good for pretty much all option investors. And specifically, the poor man's covered call strategy gives you the ability to have a lot of exposure to a stock without having to put up that much capital into it. So, if we were to buy 100 shares of Apple, right now it would cost $21,000. But with a poor man's covered call strategy, I'm going to buy a call option that is going to expire on March 21st, 2025. Now, the reason why I'm going so far out into the future is because I'm looking to buy a call option out in the future to mimic owning stock, okay? I want it to literally be very similar to owning a stock. And for that reason, I'm going to pick an in-the-money call option that's expiring way out into the future. You can go 6 months, you can go 12 months, you can go, 12 months is perfectly fine. That's probably like the textbook standard would be 12 months. So I'm gonna go ahead and buy a call option. So what we're going to do is I'm going to expand this 160 right here. You can see the delta is 0.93. That's a little bit overkill. It's a little bit too much in the money. I don't need that much. I'm gonna go for the 170, 90 delta, a little bit too much. I'm gonna go for the 180. 86 delta is pretty good. It's still kind of like on the high end. So let me go for it's actually pretty interesting how high the delta is. I'm surprised because I know Apple's like above 200, but still I didn't know that the chances of being above 190 would be so high. The delta right here is going to be, if I go ahead and buy this, it's telling me to buy it all in one swoop. But what I want to do is I want to create a 2 option order. So what I'm going to do instead right now is I'm just going to go and buy, I think it was 190, right? Yes, it was 190. So I'm going to go ahead and buy the 190. But now I'm going to go to sell, and I'm going to sell a different expiration date. With the poor man's covered call strategy, you want to sell shorter term call options. You can go for weekly income, which I don't really recommend because it is a whole lot of management. You can also go for monthly expirations, which is probably the sweet spot for me. I like 1 to 6 weeks, but for poor man's covered call, definitely 4 to 6 weeks would be much more ideal. Even 8 weeks is perfectly fine. So especially if an option is expiring in 1 year, you can go for every 8 weeks because that's 2 months, and then you can do that basically 6 times in a year. So the goal is actually very interesting with the poor man's covered call strategy. Let's take a look at the call option itself. So if you just have a call option, it can rise in value, and the short calls can lose money. Basically, that's what can happen, right? You can lose money on the short call, you can make money on the long call. Or you can lose money on the long call and make money on the short call. So it's a little bit interesting because you're either losing on one or the other. However, what if I told you can win on both? So that is very possible, and that's what I aim to do. And here's how I find the sweet spot of managing the strategy to make both happen. Basically, I pick a stock that is bullish, right? Apple has been bullish. Then I will sell a option that is expiring in 2 months. So let's just go for August 16. Just copy this logic if you're watching this in the future. So what I'm going to do right now is I'm going to sell a call option. I'm going to sell out of the money. So I bought an in-the-money covered call. I'm going to explain to you how this all works in just a second. I know it's a little bit confusing. This is a little bit harder of a strategy than a typical spread or other covered call strategy. This is a little bit more complex, but I promise I'm going to explain everything to you. So if you do a sell call, you can sell an out-of-the-money call. If I was going to do a 2-month out call, I wanted to have an 80% chance of success or higher, so I'm going to pick the 235 right now. So this 235 call option basically has a delta of 0.19, which is really good. It means 80% of the time I'm going to win, and 19% of the time this option is going to go in the money. So that's a good thing. I'm gonna end up choosing this option right here. So the 235. So now you can see that I'm going to be selling the 235 call, and I'm going to be buying the 190 call. So here's how it works. Let's just kind of reverse engineer what can happen. So the first thing that could happen is, let's say that Apple just stands still. Okay, the long call option is going to lose some value because obviously like call option benefits when the stock goes up, and if the stock doesn't do anything, this option will lose some value, but the 235 short call will just profit $2.12. So at 8.16, you will make $2.15. So that's $215, and you're putting up roughly, right, it's like $3,400. So you can make like 7% in 2 months. That's pretty good if the stock did nothing. You're literally making 7%. Now, the other thing that can happen is obviously the stock can go down. In that case, you're gonna end up losing money. This is a bullish strategy. So you will lose money if the stock goes down. Just being honest with you, you're gonna lose money. If the stock stands still, you're going to see a small return, okay? So although you're gonna make $218 or $215, the long option may lose half of that. So it may lose 100, you may make 200, so you're gonna end up making $100 on 3,000, so you're gonna make 3.5%. So sorry, you're not gonna make the 7% because you're gonna make 7%, but the long call option is gonna be losing some value, right? It's losing and it's decaying because nothing's happening, okay? So you're gonna make 3.5% in 2 months. Not too bad, all right? But here's where this strategy is strong, okay? I know I haven't been doing justice yet because I've been basically talking about this strategy losing or breaking even. But look, if Apple goes up by just 2%, 2% would be roughly $5. If Apple goes up 2%, this strategy right here is going to print money, okay? So what's going to happen is the 190 call is probably going to go up in value a little bit. It's gonna probably go up by a very small amount, not that much. It's not gonna go up a lot because, well, 2 months will go by and it'll experience some decay. But if Apple goes up just 2%, that's $5. This long call option probably gonna go up in value by $1 or $2, okay? So Apple will be up 5, this will be up, say about $2. But this call option right here will expire and you're gonna make another $2. So this is where you're gonna make $4 or $400 on this position, which is only 3,400. So you're gonna make an over 10% return. Now, if Apple goes up by $10, which is a 5% move, right? Roughly 5%, this is what would happen. Now, because this call option is gaining delta, it's gaining delta because the more in the money it is, the more correlated it is. By the way, I'm being very conservative. Now that I think about it, since this is an in the money option, the 190, you're probably gonna make more than $2. But let's just stick to $2, another example. Now, if it goes up $10, this option has 80 delta, right? 80 delta. So 80 delta times $10 is $8. So you're gonna make $8 on the long call option minus some decay. So let's just call it $7. And the short call option is still out of the money. So it expires worthless and you can do it again, right? You can sell another call option. So basically you're gonna make $7, right? Plus the 2, so you're gonna make $9 on 3,400. That's a 30% return. So if Apple stock goes up 5%, you're making 30%. So basically you have a 6x leverage factor in this example. If Apple goes up 15% or 20%, things get very, very interesting. So if it goes up 20%, obviously you will have a loss on the short call option. The short call option is actually going to cost you some money. You're gonna have to close it out because 20% more of Apple's current price is going to be like $250. So this will be $15 in the money. So you're probably gonna have to close it out for $15 because that's gonna be the cost. There's not gonna be any more time value at expiration of the August 16 expiration. It's just going to be $15 negative. However, the long call option will go absolutely bonkers. So if Apple went to 250, this would now have an intrinsic value, right? 250 minus 190 would be $60, not even counting the time, okay? So right now, there's a whole lot of time to this option. There's a lot of time, right? Because Apple's nowhere near, 190 plus 36 in premium, as you can see here. Apple's not near 226 right now. So there's quite a lot on this option. 50% of the option is like time premium right now or more. So if it went to 250, you would have 60 intrinsic value and probably another 30 extrinsic value, meaning the time that there's still left on the options. So a lot more can happen. Not to mention Apple, if it goes up 20%, that means volatility increased, and this long call option benefits from higher volatility. So basically, the long call option can be 60 intrinsic value and then like 30 extrinsic value, extrinsic in time, but there's going to be more because it will increase because of the Greeks, right? There's delta, there's theta, there's gamma, there's vega, and so on and so forth. That's not that important. What's important to understand is options go up. If you're long call options, they go up with more volatility. So there's going to be time left. It's going to be $60 in the money. Basically, long story short, this is going to be like $110 worth. So it's going to be like 11 grand. So you're going to make 11 grand, but the short call option, you're going to lose 1,500. So you're going to make $9,500, which is pretty wild given that this option is worth like 3,400. So you can basically triple up your money. However, you're probably going to have to like roll and manage this position along the way, because as it goes up, you're gonna want to close out to 235, okay? You're gonna wanna close out to 235 and roll it to 240, 250, etc., okay? But long story short, the poor man's covered call strategy will have huge results, huge benefits if you pick a stock that's going up. So this is basically the best strategy that I would use on a bullish stock. So if you look at NVIDIA, you're going to have a lot of profits versus buying NVIDIA stock. It was very expensive. Now NVIDIA has had a stock split, so it's a lot cheaper. But before, the poor man's covered call strategy would have literally printed money on NVIDIA. You would have made so much money, you would have retired had you put in even like 10 grand into NVIDIA. The poor man's covered call strategy would basically give you probably multiple six figures right now on NVIDIA if you have been using the poor man's covered call strategy and you've been selling out of the money options. Well, out of the money options, of course, because when you're looking at volatile stocks, you want to go for out of the money. For example, I can kind of edit this position right now. You can see here. So let's say that I was very bullish on Apple or whatever stock. We're using Apple in this case. I don't have to do 235. I can go higher out of the money to 240, because if the option goes into the money, that's not that good because there is a chance of assignment. And when the option is in the money and it's close to expiration, not that good because your chance of assignment continues to increase as you approach expiration. Therefore, you want to pick your strike very closely. You want to be very smart with your strike, and basically you want to pick a strike that has good resistance. So let's say Apple has good resistance at 235. You still may want to go very safe and sell like a 240 because that is going to be higher than 235. So whatever you think you need to do, always be safer and more conservative than what you have to do, because options are leveraged. There are risks with options. Generally speaking, when I'm doing covered calls and selling puts, that's safer than stock investing. That's safer than any other Forex, crypto, whatever. That is the safest thing, period, for retirement. I have so many students that are retired selling options. But when it comes to the poor man's covered call strategy, it is a leveraged option strategy. So yes, you can make a lot of money, but you can also lose some money. And now I'm not gonna say this is that risky of a strategy, because it's not. If you have, let's say 10 to 15 positions, you should have like different stocks that you're invested in. And if there's a bear market, the poor man's covered call strategy will suffer, but everyone will suffer in a bear market. So I'm just telling you all the truth. I'm telling you everything that you need to know about the poor man's covered call strategy. And for me, again, the long call has to be about a year. The short call can be a month, 2 months. You have to pick stock that you really, really like. So this was an example on Apple. I'm going to give you another example right now. We're going to go into my portfolio and look at some other examples. By the way, right now I have Apple, I have Amazon, I have American Airlines, I have Palantir, I have Target, I have Walmart, PayPal, Shopify, and QQQ. By the way, we're just going to take a look at QQQ because Triple Q is actually a very good candidate for the poor man's covered call strategy. Because if you have a small portfolio, or medium or large, it doesn't matter, but specifically if you have a small portfolio, doing QQQ really benefits you if you're going to be doing poor man's covered calls, because a poor man's covered call allows you to put up very little capital to own lots of exposure. And since QQQ is already diversified, you really don't need anything else other than QQQ. So you can gain all of your exposure into the index fund of QQQ by just running the poor man's covered call strategy. So here's what I would do. I would go to trade, and I'm going to, again, buy a call option. Now, QQQ has many expirations. The expirations go basically every single day, but as you go out into the future, they are, again, monthly. So I can go for something like December or January or March or June or even December of 2025, and it goes on and so forth up to end of 2026. So let's just say that you want to do like a shorter term trade. Let's say that you don't have that much patience, so you're going to go for November. So if you go ahead and buy a call option in November, which is only a few months away, pretty crazy how time goes, right? But November 15, if you go ahead and buy an in the money call option, so let's go for 450. The 450 has a 95. It was a little too much. Let's go for 455. Delta, sorry, I was looking at Vega. That was incorrect to me. But the delta here is 0.73, which is perfect. So I'm gonna go ahead and do the 0.73 for 455. And now let's just say we wanna make daily income. Let's just go a little bit different. Or like, yeah, today, I can literally sell a call option today now. I don't have to have shares of stock. I can use a call option to function the same as 100 shares. That's the beauty of the poor man's covered call. The long call option functions the same as shares, so that gives you the ability to sell a covered call, which is why it's called a poor man's covered call, because you don't have to have 100 shares. So now I can just sell like daily call options if I wanted to. I can make like $46 like right now, or $48 right now by selling this call option. However, that would be a lot of work. This call option is very close to the money, so you can see the delta here is 0.48. That would not be ideal. This right here would be pretty good, but $12 per day is, it's not that great, but the long call option that I have here is $4,000. So I guess $12 a day would be not bad, because in a 30-day period, if you can make $12 a day, assuming the market is open every day, which it's not, so you would only be able to do this like 20 times a month. 20 times the $12 would be like $240. $240 divided by 4 grand is gonna be like a little bit over 6% per month, which is pretty good actually. 6% per month is more than Warren Buffett. It's more than the best investors ever. So this strategy right here basically can make you quite a lot of money. So if you want to watch another video on poor man's covered calls and really nail down this strategy, because if you have a small portfolio, I think it's mandatory for you to know this strategy on a deeper level, then you should definitely check out my other poor man's covered call video right here, where I'm going to go over some more examples and help you solidify all your knowledge on the poor man's covered call.